Hello, everyone, and thank you all for joining us during the Lytham Partners Spring 2024 Investor Conference. My name is Adam Lowensteiner, Vice President of Lytham Partners. Before we begin, for those not familiar, Lytham Partners is one of the country's leading investor relations firms. With more than 2 decades of corporate access experience, we have built one of the industry's most diverse and effective platforms for connecting small cap companies with high quality and focused institutional investors while creating a framework of best practices in all aspects of investor relations. Today's discussion is hopefully yet another example where we can bring value to multiple constituents. To learn more about Lytham Partners and the investor relations programs we can provide, please access our website at www.lythampartners.com. For this panel discussion titled GPS for Alpha, Investing on a Global Basis, we welcome Jake Barfield of Asheville Capital Management and Doug Weiss of DSW Investment. Jake founded and operates Asheville Capital Management, a registered investment advisor, RIA, that manages a concentrated portfolio of global public equities and has recently launched in early 2022. Jake previously worked at Bears Capital Management and 910 Capital Management. Doug manages DSW Investment, an RIA focused on value investing for individuals and pensions. He has more than 19 years of experience analyzing stocks and bonds and identifying undervalued securities. Hi, Jake and Doug. Welcome to the discussion.
Thanks for having me.
So maybe to kick things off, can you tell us a little bit about yourself, your background, what got you interested in smaller publicly traded companies? Jake, I'll start with you.
Yeah, sure. So my first job out of graduate school was working for a firm called 910 Capital, which focused on US microcap companies. And so they would define microcap companies as anything under 500, 600 million of market cap. And I was hired as an analyst, and that was sort of the job. The reason I've stuck with it over time is because I find there are better expected return opportunities in this space. So yes, the fail rate is really high within small cap, micro cap land. A lot of companies tend to not go on to produce outperformance, but a lot of your big winners come out of this area as well. And if you're willing to sort of dig in deep, do fundamental analysis, in-depth fundamental analysis, you can find some really attractive opportunities with significant source of variant perception. So that's sort of why I've focused on smaller companies over my career.
Doug, how about yourself?
So I started on the sell side. I worked for a couple of the investment banks, and then I went to a family office, and I worked there for 10 years. And I guess at the family office, I did a lot. I got into looking at a lot of smaller companies, and agree that you can generate more outsized returns there. So I do a little bit of everything, but I continue to like to have some representation of smaller companies in the portfolio. It's also an opportunity to get more access to management. It's easier to have an ongoing dialogue with some of these smaller companies.
So I'll point this one. We'll start off with Doug. Have you always been investing on a global basis? Why should investors look globally? Aren't there enough ideas here in the U.S.? What's the attraction? Are there better valuations? What do you think, Doug?
I think valuation is the big one, honestly. A lot of people have pointed to the UK exchange as one of the cheapest exchanges in the world. So I think actually, one of the challenges on the microcap side has just been, a lot of these smaller companies have underperformed, and it's gotten harder to find really high quality companies at good prices. They're out there, but I think it's gotten a little tougher to outperform in the space. And I think, at least for me, one of the nice things about some of these international markets is you can go a little higher on the cap structure and still get some really compelling valuations. So yeah, that's the idea on my part.
Jake, how about yourself? You've been investing on a global basis, and what should investors look for? Are there enough ideas in the U.S.? What's the attraction?
Yeah, I think just to go back on the previous question, in terms of the international. I would agree that with the discount that's there,
Mhm.
I would. I think there's also a point to be made that there's a more favorable competitive landscape in some of these international markets. So like, I'm thinking of a company in particular where there's been a very successful business model done in the United States, and you can find similar business models riding similar large tailwinds that are sort of like global secular tailwinds that are occurring internationally. And there's just fewer capital chasing some of these opportunities. And so you can have, and they're earlier in the inflection curve, like if a company's earlier in the e-commerce penetration, then you just have lower hanging fruit from like a customer acquisition perspective. And there's fewer capital, so there's fewer competitors. And so you can find more attractive payback rates, especially if you're a fundamental investor and you're looking for, attractive growth of intrinsic value over a longer time horizon. So do you want me to now move on to the other question in terms of what I look for in international markets?
Sure.
So I primarily look in developed markets. You know, mostly developed markets and historically with a tilt towards capitalism. And I don't necessarily mean capitalism, like it doesn't necessarily have to be, there's a lot of countries that are socialist, but I mean capitalism like in the heart of the term capitalism is that people respond to incentives when those incentives are in place and strong enough to produce a result. So there's a couple companies that I own in technically socialist countries, not China, where the value proposition is compelling enough to say, okay, a customer should respond to this, or a potential customer should respond to this. And the ownership structure is in place to say the CEO should behave in this manner in order to grow the intrinsic value per share because he or she is incentivized to do so. Because of the sort of developed market and the legal protection for like the ownership of those assets. So hopefully that answers your question.
Does. Thank you. Doug, what are some types of geographies that you look for and why?
Yeah, I try to stay as close to home as I can. So, Canada, the UK, I think are culturally, language, pretty easy to have a sense of what's going on. I occasionally I'll stray from those markets, but I would say my batting average is better when it's closer to home, and I think the further you get out of your strike zone, or the further you sort of, as you get into geographies and cultures that you don't really understand, I mean, I'm sure people do it well, but for me, I'm just more apt to make a mistake because, I don't really have that background, and when things don't go well, which inevitably will happen sometimes, I don't, the more things you're guessing at, the more prone you are to make a bad decision. Or at least for me, that's been my experience.
So along the lines, Doug, that you just mentioned, where you look, how is the access to management? Are there any hurdles that investors should be aware of when, when considering investing overseas?
Yeah. So I mean, I don't know if we're including Canada as a non-US market, but I mean, I think Canada tends to be pretty good. I think as you get into, Europe, and really Europe would only be, I don't have any experience outside of that, but I would say it's okay, but it's a little clunkier, a little harder. I mean, generally speaking, these are going to be a little larger in the capital structure, at least the stuff I'm looking at in Europe. And so it's going to be a little harder just on that front. And then there's a time difference. And then just in general, I think even, I have a friend who works for a large hedge fund we're both in a couple of the same UK names. And even for them, even though they're a 5% investor, they're not getting great access. I think just culturally, some of these companies are not spending as much time talking to investors. You know, which is okay by me as long as they execute well. But yeah, I'd say it's a little harder, but it's not impossible. But I'd say I have less contact. You know, I mean, with a U.S. smaller company, I might be talking to them, you know, once a quarter. With one of these, you know, international companies, it's probably more like once or twice a year, honestly, or maybe twice a year.
Jake, how about yourself? Are there some countries easier to invest in than others, do you find? And how's the access to management? Are there any hurdles investors should be aware of when, you know, considering investing overseas?
Yeah, so I invest with it's much more diverse. It's much more spread out geographically. So I own a few companies in Japan. I own a company in Australia. I own a few different Eastern European companies, not Russia or anything like that, but like in Poland. And I find that it's easier, at least to understand the company and sort of the business model from an initial research perspective if the language is originally rooted in Latin. So like, you know, you think most European languages, whereas most Asian languages are not necessarily rooted in Latin. And so there's significant translation differences when you either translate yourself the documents, or even if they provide translations, there's like 6 different words to express different degrees of emphasis on certain English words that might be translated, and it all translates as the same English word. Particularly, I'm thinking of Japan, as well as the difficulty that Japan is an extremely contextual language. And so it tends to translate very wordy and be very, very difficult to understand. With that being said, though, like there is the opportunity for significant varied perception if you can understand sort of the industry and the way that they're operating, which I've spent the last several years looking at Japan, and I've only made a couple of investments. Because access to management is much higher in Japan for me personally. So I would split Japan into 2 different buckets. So there is currently there's a lot of money flowing into Japan in the last 18 months or so. And there's sort of 2 different categories that people are investing in. There is the corporate governance piece where there's historically been a lot of cross shareholdings in Japanese businesses, and that's all being unwound now. And so management teams are having to prioritize minority shareholders for the first time in their history in the last 50 plus years. And there's a lot of people investing in that, and it's sort of like an activist or friendly activist approach. I invest in the second bucket, which is there really are no corporate governance issues. Like a lot of these businesses have been founded in the last 20 years, sort of free from this keiretsu cross-shareholding structure. So they haven't had to worry about banks and trading companies owning significant portions of their shares. And so they've been prioritizing the minority shareholder for a long time, pretty much since inception. And you can see in the second bucket that return on equities are on average significantly higher. Growth rates are significantly higher. Rates of innovation are much higher. And within that second bucket, I find access to management being much better than anywhere else, actually, in all the countries that I've looked at. And the degree of transparency is off the charts. If you're used to investing only in the United States and you start looking at these Japanese sort of quality businesses, I would term them, you'll be amazed at the level of detail that they provide, not just in their slide decks or their annual letters or their annual reports, but also just in conversations with the management team. It's not material, non-public information. They just have an extreme degree of transparency. So hopefully I answered your question. It was a little bit wordy, but
that's great. That's great. Right back at you, Jake. Are there any themes or particular industry verticals that you focus on? If so, which ones, why? And are there any particular parts of the world to find specific industry verticals?
Yeah, so I mentioned this a little bit earlier. So I have historically focused on US businesses from small cap But I also had a period of time where I was looking at mid and large cap companies. And in my previous firm, I had this sort of like database in my head of these really successful business models that I really admired. I don't know, 20 or 30 different businesses that I really admired that I executed very successful business models in the United States. AutoZone is a really successful business in the United States, and I've long admired AutoZone. And I began looking internationally by saying, are there any AutoZone comparables across the world? And sort of like finding a list of those businesses. And I currently own one, a European business that has a very similar business model. And so I found that to be very successful. For me, is to find really unique businesses that have succeeded in the United States with a value proposition, riding secular tailwinds that have allowed them to succeed, that have proved out over the course of multiple decades. And then seeing how those tailwinds have evolved internationally, and oftentimes they are further behind the United States. Like e-commerce is another trend that is unfolding across the globe that is way behind pretty much everywhere else except for maybe the UK and China. And it is unfolding, it is growing, and they're sort of earlier in the inflection curve. And you can find some really attractive businesses that are executing profitable business models that are actually, in most cases, more attractive from a unit economic perspective than their US-based comparable.
Doug, how about yourself? Are there any themes or particular industry verticals that you focus on? And if so, which ones?
Yeah, no, I think that's a good point about looking for models that have worked in the US, and I guess that's something that I kind of keep in the back of my mind. And it is, yeah, I mean, for example, the do-it-yourself retailing industry has done well here, and it's kind of earlier stage in some of these European countries. I think there are a lot of examples like that. I try again to, I think, at least for me, and I feel like I'm already a little more out of my wheelhouse when I get into these other countries. So I just try to keep it as simple as I can. I try to keep it simple in general, but even more so, in the UK or wherever, I'm trying not to get into businesses where the business itself adds a lot of complexity. Yeah, so no, I don't have any particular criteria, but I would say, the businesses I'm in would be sort of old industry, you know, um, do it yourself retailing, home building, auto retailing, things that are pretty understandable.
So, Jake, when it comes to micro cap or small cap investing, are there better geographies or countries to scout out for alpha? And if so, which ones and why?
I find there to be an attractive opportunity in Japan right now in that second bucket of companies that I was referring to that don't have those corporate governance issues. So there's less private equity and venture capital in Japan. And in order for companies to raise capital, it incentivizes them. And it's also extremely cheap. Like cost of equity is extremely cheap. And it incentivizes these businesses to IPO at earlier stages in their growth cycle. Now, that also means that there's a bunch of companies that have no business being publicly traded, being listed on the Japanese stock exchange. But you can also find some really attractive businesses that are sort of, if they were in the United States, they'd be another 5 years out from IPOing. Just because it's easier for them to raise capital at more attractive valuations, at lower sort of valuations, or just to raise capital, period, in the United States. And that doesn't exist in Japan, at least not right now, although that could be changing. However, it's a really attractive hunting ground to find businesses that have IPO'd in the last 6 or 7 years in Japan that are trading at significant discounts relative to their inflection curve from an earnings perspective. So.
Okay, great. Doug, how about yourself? When it comes to micro cap, small cap investing, are there better geographies or countries to scout out for alpha? And if so, which ones and why?
Yeah, I mean, I kind of go back to the same kind. I'm willing to. If I were closer to Japan, or I don't doubt that that's a good. I did own some Japanese stocks a while back and got a little bit burned on the currency, so that kind of soured me a little bit to the whole. But that was kind of my bad for not sort of thinking more about that. I think the UK is attractive right now. I think there's always opportunity in Canada. I think those are the markets that I'm mostly looking at. I think there's a lot of opportunity. I mean, you just look at some of the South American ADRs. Everything. Many international names are way down, although maybe they've bounced a bit. But I think there's a lot of value out there. But I really do think, at least for me, that you have to be careful, because if you're in markets that you don't really understand, you not only you have currency risk, and you have just cultural risk, and so.
Yeah.
But yeah, so I'm long answer, but to just say that I'm pretty much focused on Canada and the UK at this point.
Got it. Anything else you want to add before we conclude the discussion, Doug, and then we'll go to Jake?
Well, I just mentioned currency. I don't think you can really talk about investing internationally without, sort of saying that currency is going to be an important factor in your performance. And you have to think about whether you want to hedge the currency or you want to be long the local currency. And, I think that's actually been a big factor over the last couple of years, because, if you were to look at a chart of the pound against the dollar, or the Canadian dollar against the American dollar, or the Japanese yen against the dollar, it's been pretty volatile. And there's been pretty long stretches where, if you were, so to use the example of Japan, I actually, it was, just what Jake is describing, a sort of small emerging Japanese technology company that was performing well, but I think I ended up losing a little bit of money because the yen depreciated so much, and because I was straight long. So you have to take that into account. I actually think if you go back a year or so ago, a lot of these, like the UK pound and the yen, were so depressed that risk had been perhaps mitigated to a large extent. But anyway, that would be one. I guess the other thing I'd mention is that these a lot of these names, even if they're kind of $1 billion plus in market cap, or they're a couple billion in market cap, they still tend to, there's not that much liquidity in some of these markets. So it's not that unusual to wake up on an earnings day and see the stock down 20% plus. You just kind of have to be prepared for that. I had one holding going back a year or two ago. It was very small. It was just kind of a watch position, but I opened up my quote screen. It was down 70% at the open. I was just, this is a hard game. So, yeah, they can be quite volatile. That would be the other thing which is, can be an opportunity, right? If you're kind of ready to go and you've done the work, but it can be tough if you have a full position in something.
Jake, anything else you want to add before we conclude the discussion?
Yeah, sure. I would just add, going into an international company, you are likely to be disappointed if a core part of your investment thesis is for there to be a multiple re-rating within a certain period of time, 6 months, 12 months, 2 years. You're likely to be disappointed. A lot of these businesses, there's an international discount that has persisted for a decade, if not longer, and could continue. I think you have to go into it with a business ownership perspective of maybe I'm buying it at, you know, a 7 or 8% yield on free cash flow or owner's earnings or whatever your metric is for earnings, and you know, say they're going to grow earnings at 5, 10, 15%, whatever your estimate is for that business, and say, okay, if I buy it at X amount, then my yield will increase, or my rate of return will get paid back via the cash flows of the business. Like there definitely has to be like a pretty firm business ownership perspective. And your biggest advantage in investing in these international companies is time, really, just like owning these businesses over multiple years. In order for the earnings to reveal themselves, in order for the earnings to grow. And if you get a re-rating, that's fantastic, but I would not count on banking on it like you maybe have historically been successful doing in the United States. That's all I'd say.
Great.
Yeah. I'll throw one. Jay kind of reminded me that, you know, a lot of these names also have pretty generous dividend policies. So if you're trying to run you know, an income portfolio or a different portfolio, these can be pretty nice options. And you should just, depending on your tax situation, you should just be cognizant that different countries have different tax withholding policies. Some are, you know, like the UK doesn't have any real withholding. Canada has withholding. You can just pull it up on the internet, but it does make a difference if you're a tax-paying investor.
Great. Thank you, Jake and Doug, for your time today. We greatly appreciate it. We hope everyone will enjoy the Lytham Partners Spring 2024 Investor Conference. Thank you, everyone.
Thanks, Adam.
Thanks.
See you.